Hi everyone. Welcome to this new session for the CA Foundation May 2018 course. Now guys, as you very well know, your exams are the CA CPT exams. Now they have undergone a change this year. That is, from this year, instead of having all your four subjects on the same day, according to the new foundation course, you're having four different papers on four different dates. So here we are for the Principles and Practice of Accounting paper, which is your first paper and will be there on the 10th of May 2018. Now, maybe some of you are the those who have not yet enrolled for this course. So, nevertheless, go through our sessions and surely you will get a complete hang of what lies ahead in your path to the CA course. Now, all of you must not be from the commerce background, right? So there would be some people from the science background or humanities background as well who are now thinking of taking the path of CA. So I'm going trying to make the things easy and take them from the very beginning so that there is not a single student here who cannot understand it. So taking that same thing forward, the same beginning part forward, I will be beginning today with the theoretical framework of accounting. Or for those who have already done accounting in classes 11th and 12th, you may feel that this is something we are very fond of. But the problem is that we tend to forget what we have done just as soon as we give our exams. So a refresher would be better for all of us. Now, talking about our paper 1, we have the marking scheme and the chapter list as first chapter, that is the theoretical framework, would be there in your paper for 5% to 10%. So we can say that out of all the chapters, the least weightage has been provided to theoretical framework. Now, there's no rocket science to understand that accounting is a practical subject, and that is why the theory portion would take up the least amount of time for us. Now, then is your chapter for accounting process. Now, accounting process basically talks about all the books of accounts that we would be preparing throughout the year while maintaining the account books of the organization. So, this accounting process chapter deals with the journal, ledger, trial balance, then the cash book, and the subsidiary books. Then we have bank reconciliation statement. Again, a chapter from your class 11th course. Bank reconciliation statement is a chapter which will be dedicated to finding out the differences between the balance showed by your bank and the balance that is appearing in your cash book. Then we have a chapter on inventories, which is basically connected with the valuation of inventory or stock in an organization. Finally, this entire marking part culminates with the depreciation chapter. Again, we have done depreciation, the straight line method, the written down value method, but the only difference would be that now we will be going into much detail. The questions may be much more at a difficulty level, and plus we will have also questions dedicated to the change in the method of charging depreciation. Now, all these units taken together are for 20 to 25%. Next comes accounting for special transaction. Here we are going to talk about joint venture accounting, consignment accounting, then we are going to talk about the bill of exchange. This entire unit will take up 15 to 20% of your marks. Then is preparation of final accounts for sole proprietors. Now, for sole proprietors, as we know, the final accounts contain the trading and profit and loss account and the balance sheet. So that plus partnership accounts, which we have done in class 12th, that is how a partnership runs, how does the change in the relationship between partners get reflected in our partnership books? Then we have financial statements for non-profit organizations or not-for-profit organizations. Here we are going to talk about the financial statements of any organization which is not having having profit as the primary objective. So that means it would be applying to libraries, clubs, societies, NGOs, all of them. Now, all these chapters, that is chapters 7, 8, and 9, combinedly would make up 25 to 30% of your paper. Company accounts. Now, company accounts, here we are going to talk about the issue of shares and debentures. Again, apart from your class 12th, that is the journal entries that are passed at the time of issue or redemption of shares or debentures. Now, this is going to take up 10 to 15% of your paper. Finally, we have basic accounting ratios. Again, the ratios are almost the same that we have studied in class 12th, but we may have some one or two extra ratios. Then this goes to again 10 to 15%. Now, uh, some of you may be thinking, why can't they give a direct percentage? The point is that in accounting, the questions, each and every question is worth some different level of marks. So that is why they have given you a range of marks rather than the direct percentage of the chapter. Now, in our sessions, we will be taking each chapter in a separate session. So, my session for today will be based completely on theoretical framework. And the next session, that is on 11th of April, we will be having accounting process. So, without much ado, let's start with the theoretical framework of accounting. Now, the procedure of accounting. Procedure of accounting basically talks about what do we do in accounting. Now, for those of us again who have done accounting, one definition was told to be remembered always. Now, the definition was accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money transactions and events which are, in part at least, of a financial character and interpreting the results thereof. Now, this definition leaves out these two words, analyzing and communicating, but let's take up all of them in detail. Now, the accounting process basically says there are two portions of accounting. One is when we create the accounting information, and the second is when we use the accounting information for the benefit of the users of accounting, or just as a having benefits for the future decision making of the organization itself. So now when we talk about generating accounting information, our entire process starts with basically identifying transactions which can be recorded in accounting. Now, see, accounts is dealing with money only. So if I say that uh, XYZ is a very good salesman, this sentence does not have any particular working in the accounting processes. But if I say XYZ is a very good salesman as he has made a sale of rupees 2 lakh. Now, the amount 2 lakh is making relevance to us because it is dealing with money. So we will be recording the sale of rupees 2 lakh in our books, but XYZ is a very good salesman. That part is a theoretical thing, and in accounting we do not have place for anything which is not dealing with money. So we will say that we are very money minded here. We are constantly putting all our attention in thinking what is related to money, and then using that portion for all our future uh, process working. Now, recording basically means making a note of the transactions. That is, it is the first stage where the books are actually started, and we make a journal for recording the transaction. Then we have classifying. Now, classifying basically means categorizing the transactions according to their varied nature. So, classification is the process where we divide the transaction. Now, why is it necessary? If I say my journal entries are for one single business for one single day, there are around, let's say, 200 journal entries. Now, at the end of the day, if the businessman wants to know what was the amount of sale today, now in that case, seeing the journal, he will get all confused and messed up. Why? Because there are 200 transactions, seeing each one of them and trying to figure out how much the sale was. It's something very cumbersome. So, what we'll have is we'll have a classification stage where we'll be making ledger accounts. Now, ledger accounts are made to basically categorize transactions. So if I have a sales account, if it will contain all the transactions related to the sale of goods, so that there is no ambiguity, no confusion of any kind. Then comes the stage of summarizing. Now, summarizing is basically the place where we are making our final accounts. That is, till now we are using the information to record and classify. We are not trying to find out what is the result of our operations. Summarizing basically means uh, getting our business to a level, or finding the level at which our business is performing. That is, what is the profit that we are earning, what is the financial position of the business. So basically the part of summarizing is like the report cards that you get. Now, why? The whole year round you're laboring around, giving one test after the other. First there's the UT, then there's the first term, then there's something else, and else. Now all the year round your teachers make list for every single test that you give, right? Now that's the stage of recording. Then they classify. That is, they sort the list properly. These are your accounts list, these are your eco list, these are your maths list, these are your business studies list, and these are your English lists. So they are classifying. And at the end of the year, what did they do? They put it in a table form, all the subjects, all the tests, and then they find out that little thing known as the percentage, or some people have the grade point. So what is that? That tells you what is the end result of what you have done. All the year round you were laboring around. What is the result? And results are very important, because till the time we do not get to know what is the actual result of our operations, we cannot pinpoint our weaknesses or strengths that could help us in the future. So summarizing is the stage where the business tries to understand where it stands, what it has done, so as to find out the ways for improvement or building up the strength. Now, next stage comes as analyzing. Now, what does the word analyzing means? Analyze means to break down some information into a detailed form so as to make meaningful conclusions out of it. Now, again, report card comes into the picture. Analyzing means when your teacher writes in the bottom portion the remarks on your performance. What they have done is not something which is very much different from what you would do yourself, but they have seen your performance, seen how you've grown or you have digressed, and then they are trying to make comments about where you lack, what you should do, and where are the points which you are perfect at. So we're not going to talk about all the bad things. You're good at some things as well. Now is interpreting. Interpreting basically means, again, it's a future stage of analyzing. Analyzing means breaking it down. Interpreting means trying to find out how this can help us in the future. And finally, communicating. Now, communicating means giving the information to the users of accounting so that they can use it for any purpose they desire. Now, users of accounting basically means all the people who are interested in knowing about the organization's work. So, users of accounting information may be both internal users or external users. Internal word basically means those people who are inside the organization, whereas external users mean people who are outside the organization but which may require the financial statements or the financial information for any decision making that they want. Now, internal users means people inside the organization. Who are the people inside the organization? The most important level of people inside the organization is the board of directors. Now, that's only for the company, actually. For the sole proprietorship, there is no board of director. The owner is himself the director, the chairman, the president, whatever, because he's the only sole decision making authority here. In partnership, also, there's no board of directors. So, basically, what we are saying is officers, partners, managers, and board of directors. Board of directors are the elected group of people in the company who are taking decisions on behalf of the shareholders. There are thousands of shareholders of a company. Imagine all of them coming to the office and saying, I want this decision to be made like this, I want this decision to be made like this. The company will crumble out and shut down in a very less amount of time. So what do? They elect, that is, they vote for the board of directors. This elected board of directors is responsible for taking all decisions related to the company, and it is assumed that they are the representatives of the organization shareholders. Now, partners, obviously, in a partnership firm or in a sole proprietorship, the partner or the owner here is very much interested in knowing what the business is doing. Why? Because that's the person who has invested everything. That's the person who's taking the decisions in a partnership or a sole proprietorship. That's the person who is assuming all the risks of the business. So they need to know how the business is performing. Similar to, you want to know what your result is more than anyone else in the entire world, right? Some of you may say, no, I don't want the result is the worst day of my life. But the things are, in reality, you are craving to get that result, and just before the board exam result comes out, you will not be sleeping through the entire night. Now, managers are the people who have been hired to take decisions when the owner feels the work is higher, of a higher level, and they need professionals to manage it. So now the managers are the ones again who are doing the work, and they need to know whether they are doing it right or wrong. Officers are basically, we're talking about the employees of the organization. The employees or the workers, they need to know what their future holds for them. If the business is doing well, they will demand bonuses, they will demand increments. And if their business is not doing well, they need to think about other arrangements. They need to think about their own future as well. So they need to know about what the financial state is. Then is the external users. The external users are the people who are outside the business, but which may have a connection with the business profitability. Now, first of all, the external users are the investors. The investors are the basic shareholders of the companies. The people who have invested their hard earned money in the business always need to know what the business is doing with that money, whether the business is earning well or whether the business is going into a rut. Then is the lenders. Lenders are the people who have lent money either for a short term purpose or a long term purpose to the business. Then we have the suppliers. Suppliers are the people from whom we are buying the goods. Again, why do they need to know the information? Because one, they may be providing credit terms to the organization, and secondly, they need to know again about their surety for the future, whether this business is going to be there for a long period of time and will be giving us business for a long period of time or not. Then is government agencies. Now, government agencies again need to know whether you're paying your taxes properly or not, and also the national income of the country has to be calculated. So, for both the purposes, they require your profitability position. and the customers. Now, the customers actually do not have anything to do with your financial position or your financial or your profitability. But again, we people want to know everything. So we aim our product choices on the basis of how the company is performing. We see in the news that this company is going into a loss, and suddenly for us, the products are bad. We feel they must be making bad quality, understanded products. That is why they're going into a loss. Let me not purchase this. Let me shift to another rival brand. Now, that is something that a company wouldn't want to have. So if they give you their true and fair positions to the customers, the customers may not make any hasty decisions. Now, okay, guys, before I go ahead, I'm just going to mention one thing, that some of you may be feeling that we are not interacting or taking your doubts. Now, the point is, I will be first explaining the topics to you, and then I will be giving you ample opportunity to ask your doubts. So don't worry about it. Collect them. Write them on a sheet of paper so that as soon as I say doubt session, you're the first one to ask your doubts. Now, the objectives of accounting is what we are going to focus on next. Objectives basically means what are we aiming at? What's the use of this? Why would we spend so much of money, hire an accountant, give up so many stationery costs, and then make these books of accounts? What is the reason? What is the objective? So, guys, the first objective is the systematic recording of transactions. System is important in every part of our lives. We very well know that. Think about it. If you make your notes as all 5 chapters in a single register, what would you have at the end of the year? Mere chaos, right? So, in accounting, when we are dealing with money purposes, if we do not make a proper record of all the transactions, we may end up having frauds. That is, money would be misplaced or embezzled, and we would have no clue about it. Or we would have a loss and we don't know about it, so we are keeping on going into the same direction, doing the same work that we were doing without knowing that we were doing something wrong and we were going into a loss. And when we repeat our mistakes the next year, again there will be a loss. So here, systematic recording of transactions is extremely important, as every transaction should be there, should be in front of us, so that we can see it, analyze it, compare it, and also remember it. Now, this is one thing that I want to point out. How many of you would remember that 4 years back, on your birthday, you gave a treat to your friends? How much money did you spend? Exactly what dishes did you order? Exactly what amount of money did you pay for every dish? Is it possible to remember? Obviously not. We have to write it somewhere if we want to remember it in the future. So for the business, for you, the transactions were not much. You don't spend a lot of money. You don't have a lot of dealings, but still you can't remember 4 years back. So how can we expect a business who's doing 200 transactions in a day to remember that how what exact amount of money did they pay to a certain supplier? Let's say 2 years down the line, right? Now, systematic recording of transactions is done in the journal, ledger, and their arithmetical accuracy is dealt with in the trial balance. Now, the second objective is ascertainment of results. Now, ascertainment of results means finding out what the result of your operations is. For this, we make the manufacturing, trading, and profit and loss account. Now, profit and loss account is the one which basically tells you what are your expenses, what are your incomes, and then they tend to find out what exactly is the difference between them. So basically, if we have more incomes and less expenses, we have a profit, the difference between them. And if we have less incomes and more expenses, we have a loss. Okay, another thing that maybe some of you would be thinking about, that we are not going into the detail of journal, ledger, trial balance, P&L, etc. They are this chapter is just the theory. It is like the introduction of the course, and all the things, that is journal, ledger, trial balance, P&L, balance sheet, financial reporting, all of them will be there in our subsequent chapters. So basically, the next chapter itself deals with journal, ledger, trial balance, cash book, and subsidiary books, along with rectification of errors. So don't worry, all the topics are there. We'll be taking them. Then is ascertainment of financial position. Now, guys, the difference between result and position. Now, the results are how you perform the year round, and position is where you stand at the end of the year or on the date of the balance sheet. So, if I say that throughout the year you had a lot of expenses and incomes, that would give you the profit. But then, if we say on 31st of March, these are your assets, these are your liabilities, those assets and liabilities will tell us about the balance sheet. Now, the balance sheet financial position basically is what we get to know from the assets and liabilities. So, basically, what we are saying is how much do we have, how much do we owe, what are we going to get, what are we going to pay. What are we going to get is our asset part. What we are going to pay, or what we owe to outsiders or insiders, that is the owner, those are our liabilities. So, okay, in your language, if I say that you purchased some books during the year, you purchase some stationery during the year, you purchase, let's say, um, clothing, shoes, uniforms, etc., etc., during the year. Those are the things that you purchase during the year. Those are your expenses. At the end of the year, let's say you're left with a laptop, and the books have already been used up, the uniform has already been used up. Those things are you're going to buy again in the next year, but the laptop will not be bought again and again, the mobile phone won't be bought again and again. So those are your assets, they're going to be with you for the next year as well, so they will be showing you the financial position. Whereas the expenses that you incurred, they are the results, they're the contributors to the results. Finally, the last objective is communicating information to various users. As I mentioned, a lot of people are interested in knowing what you are doing with the money in your business. So, to tell them everything, you will have to communicate the financial statements, that is P&L, balance sheet, along with certain other reports, that is like the cash flow statement, the ratio analysis of the organization, segment wise analysis, all of them will be then given to the accounting users. So that means we are communicating or providing the information to the accounting users. Now, the next part or the next topic that we are going to deal with is the subfields of accounting. Now, the subfields of accounting are basically the branches of accounting. Some people tend to call it the branches, one and the same thing. Now, branches as the subfields of accounting are the various different ways in which accounting is practiced. Now, the first is the financial accounting. This is the one that we are aiming at. You know, the in 11th and 12th also, the one which you studied was financial accounting. It deals with everything, that is, all transactions related to money in the organization are dealt with in the financial accounting branch. Management account is a very recently developed branch of accounting, where we are dealing with information that is mostly important for the management, that is the decision making body of the organization, to take meaningful decisions. Then we have the cost accounting. Now, cost accounting basically talks about the uh, different costs of every different activity, as well as the units that are being produced in the organization. So basically, we can say that this is more related to the work aspect than the decision making aspect. So cost accounting would be dealing with the cost of producing the different units. It would be dealing with the cost of labor. It will be dealing with the cost of factory maintenance expenditures. So here we are not dealing with the incomes, we are dealing with only the cost which is attributable to a particular activity or a particular unit in accounting. So if I say that I have to find out the exact cost of producing each and every unit of the product in our organization, we would say we are dealing with cost accounting. Again, if I say that the machine rate per hour, that is the cost of running the machine for 1 hour is this much, we're dealing with the branch of cost accounting. Then is social responsibility accounting. Now, this deals with ascertaining what are the financial transactions of the organization which are having an impact on the society as a whole. Finally, we have the human resource accounting, which deals with the costs and the benefits derived from human resources. Now, we very well know human resources, people, they cannot have a price tag on them like we have the other assets. However, they do give some benefits and they do have some expenditures associated with them. So that is why human resource accounting in itself is evolving as a new branch of accounting. Now, concepts, principles, and conventions. Now, guys, concepts, principles, and conventions are basically the guiding principles or the guiding rules that would help you in making your accounting books and in making decisions in accounting which are good for the business as a whole. So basically these are the things that guide your entire thinking while you are making the books of accounts. So guiding and actually giving the result, there are some amount of differences here. A guideline is something which is broad and general. It is telling you in generality what you should do and what you should not. So it is not related to your business as such. Something that is written in the concept may not be applied to your business directly. Okay, Krishna, you have raised your hand. I can see that. And as soon as I start the doubt session, I promise you I'll be taking it out. Okay. Now, the concepts of accounting only channelize your thinking into a particular direction. They do not give you clear cut solutions. We are not talking about stuff where we are given everything on a silver platter and we just have to keep on doing things. We have to make our own decisions. We have to do our own practices. But the accounting principles guide us in taking better decisions. Now, the first concept is the entity concept. Now, the entity concept, also in 11th, you have studied it as a separate entity concept. This basically means that the business is a separate identity and the owner has a separate identity in the books of accounts. So, whenever we are making the books of accounts, we are only making them from the point of view of the business, not the owner. So, all transactions you do, everything you do, you think of yourself as I'm doing this for the business point of view, not from the owner point of view, because the owner is separate, the business is separate. In layman terms, we may say this shop is owned by Mr. XYZ. So, this is Mr. XYZ's business only. So, if Mr. XYZ pays me the money or the business pays me back the money, it doesn't make any difference to me. But in reality, in accounting, it does make a difference. Mr. XYZ has a separate identity and the business has a separate identity. We should not merge them together. Money measurement concept. This says that everything has to be measured in terms of a common denominator of money. Common denominator basically means unless and until everything has been converted into money form, you cannot expect to make meaningful conclusions or get your results or anything. Now, a business has 4 trucks, it has 2 buildings, It has, let's say, 7 machines, and it has 100 tons of raw materials with it. How much is the total value of the business? How much is the value of all the assets of the business? Is it possible to find it out? No, you cannot find it out. Why can't you? Because the truck is in units, the buildings are in units, the machines are in units, the raw material is in tons. How do we make it equal? Can we say the truck and the building is of the same value? It would be stupid for us to say that. So, money measurement concept says we convert everything in terms of money, and then we add them up and we do analysis on them. So, accounting says anything which can be measured in money, record it, use it. Anything which cannot be converted into money, sorry, we cannot consider it anywhere. Now, then is the periodicity principle. The periodicity principle says that the life of a business is divided into small periods of time known as accounting periods. And for each accounting period, we calculate the financial results of the business. So, a year is surely an accounting period for all the businesses. However, businesses which are on a very large scale may also want to make their financial results available after every 6 months or even after every quarter, that is every 3 months. So all, if you're saying quarters or half years or years, what we are doing is we are making our results for a specific period of time, and then we are going ahead. Okay, to understand this better, would it make any sense if you are enrolled in nursery and after class 12th you get the report cards of all your years, and in between you did not know what you are doing, what is your current standing, whether you're doing anything good or bad? You had no idea. Doesn't make sense. So what is done? Every few months, PTM is held. Your result up to there is given to you. Then after the year, the entire result is given to you. Then you go ahead. That's the way the business works. The business can prepare accounting books for a quarter, take out the result for the quarter, then the next quarter, and the next, and the next, and then the end of the year, they will have the annual results with them. Then is the accrual concept. Now, the accrual concept basically states that uh, as the expenses and incomes have of a current year should be considered in the current year regardless of whether they have been paid or not. So what does this mean? Let us say on 31st of March you have not yet paid the salaries of March to your employees. Now we very well know March is in one accounting period, and 30 after 31st March another accounting period starts. So the salaries of March are due on 31st of March but have not been paid. So we will be writing it in our books of accounts as outstanding salaries. That is, we will consider expenses and incomes when they are due, not when they are actually paid. So we purchase goods, we have not paid for them yet. No issues. We will record it as credit purchase of goods. Then is the matching concept. Matching concept says expenses and incomes related to 1 year, related to an accounting period, to one accounting period should be matched with each other. Now, what does this mean? If I produce some goods this year and I am putting the cost of production as an expense this year, then they should have been sold this year as well. That is, income should also be generated in the same year. But if income is not being generated in the same year, then we will take those goods forward as closing stock, and in the year in which they will be sold, in that year only we will be having them as the cost. Next is our going concern concept. This says that the business is assumed to go on for a very long period of time with no intention of shutdown or a substantial reduction in the working. Now is the cost concept. The cost concept basically says that the assets are generally recorded at the historical cost, that is, the cost that we have paid to acquire them. Then we have the realization concept, also known as the revenue recognition concept. Now, this concept says that the incomes are recognized only and only when the work is being has been performed from our side. So that means if we are selling goods and somebody gives us an order for producing goods, now getting the order and getting an advance for them would not entail a revenue or an income for us. Even when we produce it, it will not be income. If when we supply it or send it, it will not be income. It will be income only when we actually deliver the goods to the concerned consumer. The dual aspect concept, this says that every transaction has two aspects. That is, it affects our accounting books in at least two manners, or two different asset or liabilities are affected. Then there is the conservatism principle. The conservatism or prudence principle states that we always anticipate losses, but we do not all anticipate or make provisions for future profits. Then we have the consistency principle. Now, all of you must know your teachers always say to you, be consistent in your performance. Be consistent means when you've done something, keep it stable, repeat it again in the same manner. So consistency basically means if the organization has chosen some methods for accounting, they should keep using the same methods of accounting year after year. Then we have the materiality concept. The materiality concept says anything that is important or that may be important for the users of accounting should be highlighted, whereas those things that are not that much important for the business use, for a small business, a loss by fire of rupees 2000 may be a very big issue, and they will be showing it as a separate disclosure. But for a business which is running into hundreds of crores turnover, a 2000 rupee loss will be written off as miscellaneous expenditure. Materiality. What is more important? What is less important? Now, next we come to the qualitative characteristics of financial statements. Now, the qualitative characteristics of financial statements are basically the features that we desire in our financial statements. Now, first of all, the first feature is understandability. What good is a financial statement if the users cannot understand what is written in them? It will make no sense. It will make it of no use to the users. So understandability means that it should be in a form and manner that can easily be understood by the users of accounting. Then is relevance. Relevance means that the financial statements should contain information that is important or relevant for the users. Then is reliability. Reliability means it should be uh, uh, you know true and fair. It should be accurate. The financial statements should be such that users can base their decisions on those financial statements. They should not be laden with errors or frauds. Comparability. That is, the financial statements should be made in a manner that we can easily compare the financial statements of 2 or more years, as well as one business financial statement with the other. Now, uh, in class 12th, you got to learn the financial statements of a company. You got to learn the balance sheet format and the P&L format. Now, why is that format so rigid? You can't change a single word out of it. Why? The reason is that if companies all over the country are following exactly the same format, The balance sheet or the statement of P&L will become more comparable. It would be better to analyze and find out what is the position of one in uh, reference to the other. Materiality, as I've said, it should focus on the most important things. Faithful representation, there should not be any kind of uh, hiding or any kind of non disclosure of information from the users of accounting financial statements. Substance over form. Now, form basically means the legal form, and substance means what is the importance or the worth of this information. Now, when we buy things, there are some things that are written on it which are important because the law has asked them to write those things on the things. Let us say, uh, you buy a pack of chips. It contains manufacturing date, best before, the MRP, it batch number. Those are the things that are told to the company by the law. They have to do it if they want to maintain their legal standing. However, if they similarly in the financial statements as well, some information is there in the financial statements because the law has asked the companies to disclose these things. But sometimes the business may also feel some other point, some information is there, which though is not legally required to be written in the financial statements, but it makes a difference to the decisions of the users. So such information should be given in the financial statements regardless of whether the law asks them to write those points in the financial statements or not. Then is their neutrality. Neutrality means that there should not be any kind of bias in the preparation of financial statements. They should be completely objective. Then we have prudence. Means to be wise. To be wise means if you have any indication of a loss in the future, make provision for it. But if there is a chance of profits in the future, wait for it. Don't go hopping around town and announcing that we are going to get this amount as profits. Full, fair, and adequate disclosure. The words themselves speak for them. And completeness. Now, capital expenditure, capital receipts, revenue expenditure, revenue receipts. This is a complete unit of your accounting chapter, theoretical framework. I'm going to explain it in a very short, small example. Okay. Anything which is going to give us benefit for a long period of time is capital. Or anything that has a relevance for us for a long period of time, that is, which is not going to end in the current year itself, is capital. So we purchase a building, that's a capital expenditure. But we purchase or we give rent for a building, that is only helpful in this current year. It's not going to give us benefits in the future. That's a revenue expenditure. Then capital receipts. We sell our machinery. Our asset has gone out. This is something which had a long term impact on a business. Capital receipts. And let's say that we have made sales of goods. That's done on a regular basis. That doesn't have a long term impact on our business. That's revenue receipt. Now, contingent assets and contingent liabilities. Now, contingent word means dependent on a future situation. So, contingent assets are all those things that may become assets in the future. So, it is a possible asset that arises from past events, and their existence will be confirmed only after occurrence or non occurrence of one or more uncertain future events. And contingent liabilities are some amount of money that we may have to pay in the future. That is, it is a possible obligation. Now, keep it in mind that assets or liabilities are in the balance sheet, but whenever the word contingent comes into the picture, it means they are not at present but may become in the future. Now, in this case, whatever is contingent will not be in the balance sheet itself, it would be under the balance sheet in the notes to accounts or the footnotes. So, uh, a very simple example for this is there is a court case pending. Now, if you had sued another company and you have a chance of winning the argument, in that case you may get money from them in the future, so it's a contingent asset. And on the other hand, if somebody had sued your company and you may have to give some amount of compensation to them if you lose the case, in that case it is a contingent liability for you. Now, the next part is accounting policies. Now, accounting policies refer to specific accounting principles and methods of applying these principles adopted by enterprises in the preparation and presentation of financial statement. These are some important points that we are discussing only. Policies are what should you keep in mind while preparing the accounts. Again, policies, concepts, and conventions go hand in hand. They are based on various accounting concepts, principles, and conventions. Three major characteristics which should be considered are prudence, substance over form, and materiality. That is, while using policies, you have to keep in mind that these three qualitative characteristics are most important ones for the selection of our accounting procedures. And this unit also contains the changes in accounting policy portion. So let us just talk about when can we make a change in the accounting policies. Now, once you adopt an accounting policy, the principle of consistency says you should maintain it for a long period of time. However, if there are one of the following conditions is satisfied, that is, one, if it is required by some statute, that is some law, or the for the compliance of an accounting standard, then you can change the accounting policy. That is, if the government through a law or an amendment mentions that a certain policy is no longer in operation, you should change it, so at that time you can. Or if you feel that the change will result in a more appropriate presentation of financial statements, then we can make the changes. Now, guys, till here I had the topics with me, and now I have some important questions, that is, the questions which are given by ICI itself. So, now is the point where you can ask your doubts. So, I'm opening the chat for you to ask them. Okay. Can I repeat management accounting? Sure. Dipanshu, I can. Now, management accounting basically deals with all the financial information that is basically important for managers in taking decisions. See, the managers are not connected with the petty things. So if there is a large company dealing with crores of money, and there the an expenditure of purchasing stationery has increased by 100 rupees, the management does not it doesn't concern the management actually. But yes, if the management has to talk about changing the suppliers, this is something that is very much important for them. So basically, management accounting will focus on only those financial transactions which have a bearing on the management or the future decision making. Okay, Krishna, you had a doubt. You had raised your hand. Can you ask it now? You're welcome, Dipanshu. Okay, guess Krishna isn't able to hear me. Jyoti, accrual concept again. Yeah, sure. See, Jyoti, accrual concept basically means that you should deal with expenses and incomes when they are due, not when they are paid. Now, let us say that your telephone expense, let us say your telephone bill is due, that is, the at the end of the month on 31st of March, your telephone bill has been generated. Now, obviously, on 31st of March, they will generate it, they will give it to you, and then in the next week or so you will make the payment for it. So tell me, is the expense due in the previous financial year or the next financial year? If it is the bill for March, should it be in the previous year, or if when you are paying it in April, it should be in the April part, should be in the previous? Why? Because you used the telephone services in March. Got it? So here we would say that although we have not paid the expense, but because we used the benefit of that expense in the previous year, we will record it in the previous year only. Okay, so at that time on 31st of March, we will write it as outstanding. And later on in the next year, we will say we have paid our liability. Okay, come on, guys. Any other doubts? Kangana, what kind of questions will be asked from this accounting theory portion in CPT exam? Okay, Kangana, I am supposing that you are talking about CPT, so you're talking about the old course. Now, the difference between the old course and the new course is that that was objective, that would have multiple choice questions, whereas here we have theoretical questions where you have to write all the things. So, in MCQs, you will have okay, I'm coming to your other question as well. Now, in the MCQ, always assume that application based questions would be more there. Application based questions, suppose a business X was using the straight line method of depreciation, and this year they changed it to written down value method without any information given to any of the shareholders or without any proper reason for the change. Now in this case, you will be given a multiple choice question: which accounting principle or convention has been violated in this case? So if they are giving you prudence, consistency, or let's say entity concept or money measurement, it is obvious that the answer should be your consistency, because we are changing a method of depreciation due to which all the things will be changing. The financial statements would show a difference. Second question, Kangana, difference between revenue expense and capital expense. That's what we just talked about. See, any expense that will give you benefit for only the upcoming year, that expense will be taken as revenue. And if that expense is going to give you benefit in the next years as well, that is for a long period of time, then it is capital. So if you buy a car, it is capital because the car is going to give you benefit for a long period of time. But if you put petrol in the car, petrol would be a revenue expense because petrol is going to give you benefit only in the current time. Similarly, we buy a building, capital expense. We take a building on rent, the rent is a revenue expense. Is there any other doubt before I go to the questions, guys? Okay, Ash, matching concept again. Okay, now Ash, see, if I say that I have, I'm just going to give you a small example for this. If I say I have produced 100 units or I have purchased 100 units of rupees 7 each, so I have spent 700 rupees on the purchase of the goods. Now, if I say I have sold 80 units at a price of rupees 10, in that case, I have received 800 as sale. Now, seeing this, you will say the profit is only 100. But is it true? No, because right now I have sold only 80 units. So the cost of only 80 units should be treated. So I will say my cost would is 80 units to match it with my income. If the income is for 80 units, the expense should also be for 80 units only. Only then will you get proper answers. Dipanshu, I will be uploading all these slides just as soon as the class will be ending. Then you can download them as well. Okay. All right. Now, guys, going to the questions. Some important questions I'm taking here. Question one is accrual concept implies accounting on cash basis. This is so stupid. Come on. Accrual means credit is also there, Cash basis mean only cash. What have we started all up throughout? Accrual concept deals with expenses and incomes when they are due, not when they are paid. And what is cash basis? Cash basis deals with expenses and incomes which are paid only. So accrual concept is dealing with cash and credit both. So false. Question 2. Finished goods are normally valued at cost or market price, whichever is higher. Now, higher. Higher means you are thinking that my stock is worth more. Okay. Now, in this case, we are we are assuming profits. We are highlighting profits for ourselves. That's not prudent. That's not wise. So, according to the principle of prudent, we say that finished goods should be valued at cost or market price, whichever is lower. Okay. Shubham, I will be giving you specific controls for that. Okay. Now, question 3, distinguish between money measurement concept and matching concept. So, as per money measurement concept, only those transactions which can be measured in terms of money are recorded, and under matching concept, all expenses matched with revenue of that period should be taken into consideration. So, expenses and incomes should be similar on a similar page. You've sold 80, you should have the cost of only 80 units with you. Question 4. Define revenue receipts and give examples. How are these receipts treated? Now, these questions, guys, I have taken from the revision question papers that have been released by ICAI itself. So, that is why the questions are important. Now, revenue receipts are those receipts which are obtained in the normal course of business. For example, receipts from sale of goods and services, interest income, etc. Revenue receipts are credited to the profit and loss account because they are your normal incomes. Now, fifth is change in accounting policy may have a material. That material word here always means important effect on the items of the financial statements. Explain this statement with the help of an example. Now, this statement basically means if you change an accounting policy, everything will change, your assets, your liabilities, your valuation, everything. So, change in accounting policy may have a material effect on the items of the financial statements. For example, method of depreciation is changed from straight line method to written down value method. Unless the effect of such change in accounting policy is quantified, that is, calculated and treated, the financial statements may not help the users of accounting. Now, I am going to take your doubts now, but I just have to announce first that on 11th of April, that is on our next session, we are taking chapter 2, that is accounting process. And there we'll be talking about journal entries, rules of debit and credit, ledgers, trial balance, subsidiary and cash book, and rectification of errors, because to err is human and accountants are also human. So, now, before I go ahead, come on, guys, give me your doubts. And I'm just uploading these slides for you to take down, download on your end. All of you, please tell me your doubts as well as download the board, because when you download, it will have all the things that I have written on them as well. I'm waiting. No other doubts. Okay. Yeah, it is up to 90%. I'm just, it will be open to you now. Yes, now try. Can you download it now? Not now, also. What is it saying now? Yes, you can. Good. Okay, guys. Any other doubt? The theory is pretty easy. I know that. That is why, uh, you know, there's not much of doubt scenario here. But still, if you have anything to ask, please go ahead. We still have 10 minutes. I can utilize that for you. Which one is better, CPT or BBA? Okay, Shivam. Now, there is no certain comparison here because both go into completely different directions. BBA is a bachelor's course. After that, you have to go to masters and stuff. But CPT, on the other hand, is a completely professional course which is not connected to graduation at all. So when you do go for CPT, that is when you go for CA, in that case, you also have to pursue a separate bachelor's degree. Dipanshu, along with CA, the best thing is BCom or BCom honors, depending on whether you had maths with you or not, because CA and BCom chapters, subjects, topics, they all coincide with each other. So it's like something that you have done in IPCC, that same thing you are doing in BCom honors first year. So it's like whatever you learn at one place will be useful in the other place as well. So that is very helpful for us. And yes, from correspondence, if you have to take CS seriously, because with regular college, doing your CA complete justice is a bit difficult. Through correspondence, it's like you can pay all your attention to the CA portion so that you clear them on time, and by the time you are graduate, you are almost becoming a CA as well. And plus you have to go through the articleship program also. So articleship is where you have to work with a accountant in an office. So with a regular course, to get do a job, it's not impossible. You're welcome. Anybody else, anything? Is there any of you is already enrolled for the old course, CPT? I guess not. Okay, guys, so no other doubts. Few teachers told me regular college. Yes, Shubham, that is true because in colleges, when you interact with people, when you go to the debating societies and everything, then that was the exposure is there. But if you feel that you have to give your 100% to CA, then that they don't go well in hand. What you can do is, if you want to just take the experience of regular college as well, so a lot of my students have done this. They have enrolled for the CPT batches, and then they have also enrolled for college. 1 year of they have attended the regular college, and when their CPT got cleared and they had to prepare for IPCC, for the second year of graduation, they migrated from regular colleges to correspondence, so that in the IPCC portion they can concentrate completely on CA. So for 1 year they have got the exposure as well, and then later they are concentrating on CA as well. So, but the best of both worlds at one place. That is a good choice. You can attend your college for 1 year, or there are many students who just do their graduation and then they go for CA. That is also true. And if you're exceptionally good at handling pressure, then a regular college plus CA is also not impossible to do, considering the fact that you do not have to go to the bunking portions or moving around with friends all the time. You have time after college to pay attention to CA as well. Then you can. Yeah, yeah, Shubham, you can migrate later. Transfers can be done from regular to correspondence later on. Yeah, you're welcome. Okay, guys. So next session, 11th April, accounting process. I hope to see you all. And plus, If you people are from commerce background, then you may have your 11th class books with you. Go through those books as well, because you know the ICAI study material is very good in its own. But the 11th class study, the TS Grewal that you must have studied there, that's in such a sweet, easy language that it's pretty much easy to understand everything. So that will give you the base. So revise the theory and the accounting process from that once, and then go to the ICAS study material, because ICAS study material will be uh, is basically made considering the fact that people have some basic with them. So for the basic refresher, take your 11th class TS Grewal and revise that as well. Okay. So that's it for today, guys. 11th April, same time, meet you. Okay. Bye, everyone. Take care.